our first session. The first session is building blocks of biochar project finance, and leading the panel will be Ryan Letourneau of Grain Ecosystems. Very good. It's all yours. Right here. Yep. Wonderful.
All right. Good morning, everyone.
Good morning.
Welcome. My name is Ryan Letourneau. I am the co-founder and CEO at Grain Ecosystem. And at Grain, we help project developers navigate the voluntary carbon market and understand and match with equity, finance investors, and other kinds of investors in the capital stack. Over the last 2 years, we've been working with project developers, solving and helping them navigate the voluntary carbon market. But with each project developer, what we started to understand is they all got stuck at the same place. How do I finance my project? And so from that, we've built the building blocks of biochar project finance in order to help these project developers understand what are the options that are out there. The building blocks are made up of 5 key blocks. And today we're gonna talk a little bit about them in detail. Starting with grants, which is a type of funding that you don't have to pay back. Bank loans, which can be senior secured or unsecured. A lot of us have experience with these in our day-to-day lives from mortgages and homes and things like that. Junior debt, sometimes called mezz debt or mezzanine debt in the industry. Carbon removal credit pre-purchases or streaming agreements, which I think we'll get into a little bit here today. And equity financing, which is the top of the capital stack. And so I'm excited to welcome to the stage a panel of investors that are active in this space. I'd like to introduce Tanner Martin, Vice President and USDA Loan Officer at Ameris Bank. Alec Kushnir at Carbon Streaming Organization, Executive Vice President of Origination and Investment. And last but certainly not least, Mr. Josh Kaufman. He is the CEO at Nexus Development Capital. Welcome. So I'm gonna go head over there and take a seat in a moment, but what I'd like, guys, to ask you the first question, which is, how did you find biochar? And what are you guys working on today in the biochar space? And Tanner, maybe you can kick us off.
Does that work? Here we go. Thanks, Ryan. My name is Tanner Martin. I work at Ameris Bank. We're a mid-sized regional bank based in Atlanta, Georgia, but we do have a nationwide lending footprint. I kind of came to biochar from a renewable energy background, so we've done a lot of project finance in solar, biogas, biomass, renewable natural gas, and we've kind of just recently leapt into the biochar space. We provide senior debt to projects at anywhere from 55 to 75% of the project capital stack, and really view this as a nascent and growing industry, and we're excited to see where it goes.
Hello, good morning, everybody. I'm Alec Kushnir. Carbon streaming invests in carbon projects that remove or reduce greenhouse gas emissions, accelerating net zero goals. We are been focused on biochar for the last 3 years. We see it as one of the most economic removal project types around. It has durability. It has co-benefits that are very attractive to credit buyers. And we're looking to grow our portfolio.
I'm Josh Kaufman of Nexus Development Capital. We back teams that are developing and constructing low carbon infrastructure, and it tends to be things other than electrification. So we don't really do much solar and wind and storage. The thesis is, what are the infrastructure funds going to want to invest in 2 or 3 years? They're all looking for environmentally friendly infrastructure other than those things. And as Alec said, I think carbon removal is a big one. And so we like biochar because it's a durable carbon removal, as Alec said. It doesn't quite feel ready for the infrastructure funds, Generate Capital, Orion, others like that. But we think it will be in a couple years. And so our model is to get in about 2 or 3 years earlier.
Awesome. Well, now that you guys have found biochar, and Josh, you said it, you have a thesis in this space for your investments. Maybe you could share with us a little bit about what an ideal project looks like for you and how it fits into that thesis.
Sure, you want me to go first?
Yeah.
Well, with any project that we look at, it's the same thing. You know, what is an infrastructure fund going to like? And those are really basically infrastructure funds want things to look like fixed income as much as they can. You know, they want to put money in and not think about it and get a fixed coupon out every single year. That means ideally, you know, really certainty on the money that they're putting in, whether an operating project or a greenfield project, if it has a fixed price EPC contract, fixed operating costs, fixed revenue if possible, fixed feedstock. You know, the more things you can fix, the more they like it. And so then when we come in, obviously not everything is fixed, but we try and think about what variables can we take that we know and what variables can we take that we don't know and get it to a point that we can know. So, you know, our strategy was, you know, within the biochar world, we decided we wanted to look really more at kind of high quality equipment, a little bit higher CapEx stuff, but we figured we would kind of know what the CapEx and OpEx would be. And then really the risk we're taking is a little bit on the revenue side. We know this market's still kind of nascent, there's a lot of variability, but we're trying to build consistency for those future investors and try and get a track record for what that revenue profile is going to look like so that the infra funds come in with a little history.
I think for the debt side, we're kind of looking at it the same way. We want to make sure you have really quality technology. We're willing to take a little bit of risk, very similar to what Nexus is, on the offtake and kind of the variability of the revenue streaming. But what you want to really make sure you have is a quality project put together, built well. I agree with you there, fix as much as possible. That's going to make banks really happy. If I go upstairs to my credit officer and he says, hey, you have a fixed price offtake, you have fixed price feedstock, that makes it a lot easier to finance than you have, you know, variable up and down on either end of those things. And make sure you have an operations team that knows what they're doing. You know, most of these are fairly de-risked from an operating perspective. It's not, I don't know, major manufacturing, but at the same time, you want to make sure you know what you're doing, know what you're getting into, and you have a staff that can manage the process and the project on an ongoing basis.
There we go. Similar to what Josh and Tanner are saying, we're looking for strong management teams with experience in developing biomass, power, or other industrial facilities. So we're looking for very attractive feedstock, sustainable, abundant, low cost, clean. I think that's key for us. Also, just on the equipment side, we're looking for proven technology that's commercially scalable. We're looking for projects that can be scaled up, minimum size around 5,000 tons of biochar per year. On the contracting side, I think we've done a good job in securing long-term offtake on the carbon credits. So we're looking for projects that have good marketing plans for the biochar and preferably offtake agreements as well.
Great, thanks. I heard a few things there. I heard predictability, I heard operational experience, and I also heard the word risk a couple of times. And we know that with every investment, the reason there's a return is because there's a little bit of risk involved. And so, Alec, maybe when you're thinking through the projects and you're starting to kind of pinpoint specific risks, are there items that you look particularly at? Is there a key risk on your radar?
Sure, there's a lot of risks in biochar. That's certain. It's a nascent kind of industry, so even in terms of technology, it's not necessarily fully developed. It's not like cookie cutter stuff. Every project is unique. So we're looking for teams that have put projects together, operated projects. For us, having a plan on the biochar marketing side is very important. Where's the biochar going is key. There's a lot of things that come up as the project's being developed. So access to capital is very important. That's the other thing. We're kind of the junior capital. We are providing anywhere from 20-40% of the project capital costs. The rest is coming mostly from senior debt. But also, as things happen, projects run over budget or get delayed, and teams need to have access to equity and other sources of capital. So having that ability to raise more capital is also very important to cover the inherent risks of these projects.
Yeah, I'll follow on that. I think access to capital is probably one of our the top things that we view from a lending perspective. Everybody can put together a model. You can say, hey, I expect to sell, X amount of biochar at X price, and I expect my EPC contract not to exceed this amount. But there's always going to be bumps. So making sure you have access to working capital to help you with that ramp up, and also to help if something kind of goes bump in the night, is going to really help to de-risk the project from a lending perspective.
Yeah, not much to add.
Well, I did hear people as a risk, right? And I think at the end of the day, we talked about equipment, we talked about offtake, we talked about feedstock, but we're investing in people. It takes people to run these machines. It takes people to sell the biochar, put it on the fields. It's people at its core. And part of that relationship between the investor and the people operating the project is trust, right? And building that trust and having trust that they're going to deliver on what's been invested in and the plan. So when we think through kind of people and trust, are there things or experiences in teams that you look for that helps you build that trust and have confidence that this is the team that I'm ready to invest in? Maybe Josh, want to get started?
Yeah, absolutely. First of all, these are complex things. They are maybe not the most complex manufacturing facilities, but there's a lot going on, and generally, you need a lot of skill sets. It's not like one person is not going to be able to do it themselves. Two people are generally not going to be enough. You need a team of expertise, and what we often look for is, as you said, the trust and kind of the self-awareness for groups to know what they don't know. We see a lot of groups out there that think they have it all figured out, and sometimes our job as investors can feel like telling people their babies are ugly if they come to us for money and we say no, and then they get mad and they say, how come you don't realize how de-risked this is? Why don't you get it? And this stuff is just very difficult, and so the groups that kind of recognize that they don't know what they don't know and there are risks and they need help, that's really important to us, because this stuff is always challenging. Things never go as expected. Yeah.
So what we're working on is basically to make biochar look as much as any other infrastructure investment as possible. So that means putting contracts around putting a commercial structure that you would typically see in any energy project. And that means making sure that, as Josh was saying, that there's really a team there. It's not just one person who's heading up. The skill set needs to be broad, and they need to be flexible to deal with problems that come up during construction and startup. Having those kind of groups there helps solve problems quickly. So we're looking for a team that would be transparent with us if there's a problem. Would communicate that very quickly to us, so we could sit down together and come up with a solution. And the two biochar projects we currently have in our portfolio, we've basically had to do that. We had to come up when challenges come up. We sit down with our project partners and figure out what the solution would be, and I think that's key.
Yeah, I can echo what both of you have said. We get involved in projects a little bit earlier on. A lot of times people are making sure that they can sort of fill out their capital stack with a bit of debt. But we need developers that are honest and realistic about what they're able to do and what they're not able to do. So if you come to me and you've never developed a large-scale energy or infrastructure type project, you say, hey, I want to self-GC this. I'm going to be my own EPC. That's probably not a realistic thing from a lending perspective. But if you're willing to admit what you don't know, and surround yourself with people that are capable and willing to work with you, and be very open and honest with your lending partner. If something comes up, something goes bump, something weird happens, and try to sweep it under the rug, eventually that's going to come out, and it's going to make it a lot more challenging to solve. So be really upfront about any challenges that may happen, and I think that goes a long way.
No, and in any project, we're going to face challenges and bumps along the way. And, I know, Josh, when we were talking earlier, we were talking about Nexus and the organization, and you have other arms of the Nexus parent company. And so maybe just to share with the audience a little bit about how you think of the organization in terms of providing support, or if challenges happen, are there things that you as an investor like to lean in on, or some expertise that you bring to the table? Maybe it's the deal design or helping with capital. How are you thinking through that and approaching the support piece or the partnership piece of the investment?
Yeah, so our model, Nexus Development Capital, is a JV with a group called Nexus PMG. We have some representatives here in the room. That's historically was an engineering and design company, an advisory firm that has since expanded, but a lot of expertise in thermal conversion, biogas, biofuels, wood pellets, whatnot. So when we do diligence on a deal, we always tap into the expertise on there, and then after a deal, we can contract with Nexus PMG for owner's engineering and construction management and whatnot. And yeah, that is really important to our model because these are construction projects, and so to be able to tap in there. So yeah, we use those expertise across all of our different technologies, not just biochar.
So our investment team is composed of professionals that come from the project finance and project development background. Myself, prior to joining Carbon Streaming, I worked in New Fortress Energy developing LNG terminals and power plants. So we do have infrastructure and energy project development experience. We also work with biochar consultants who have expertise in biochars to help us to help do due diligence and assist us in solving issues that come up during construction and operation.
So we're the debt side. We don't have the engineering experience or the consulting expertise, but what we do have the ability to do is kind of bulletproof your model. So our goal when I'm working with a developer and we're working with developers is let's take a look at what your business plan is, what are you expecting to spend, and then make sure that it is fully baked and fully wrapped, and then we're probably going to add a little bit of contingency in place. A lot of times that increases the capital cost a little bit, but for when things inevitably get weird during construction, or you have a large change order, or you have a delay in delivering biochar, I'm really glad that you have that extra working capital or reserves in place for when things go bump. Nothing ever goes completely to plan, so we try to work around that as best as we can.
Awesome. Yeah, confidence is important, and definitely having bank loans in your capital stack provides that to the other investors. And Alec, when we've worked together historically, your organization, Carbon Streaming Corp's organization's insight into the carbon markets and some of the work that you're doing there for us has been a really great benefit to see for these project developers. Maybe you could share a little bit about how you think about the carbon markets and how you support there.
So one of the most exciting things about biochar projects is there's very strong demand for carbon removal credits. So they are, very large corporations that are interested in long-term offtake on biochar carbon credits. So we see that's one of the primary reasons we are focused on biochar. And our sales team has existing relations with some of the largest carbon credit buyers in the market, focused on removals and constantly growing that relationship base. So there is right now more demand than supply in terms of carbon removal credits, especially from biochar. And we plan to leverage those relations for every project that we invest in to secure our very attractive long-term offtake for each project that we're involved in.
And for you guys, do you think about carbon credits in your model? Does it come into play?
I think on the debt side, the more robust your revenue can be, the better. So if you have multiple streams of revenue, whether it be carbon, biochar, any kind of other ancillary products, if you're getting tipping fees to create the biochar, or you're creating bio oil from the syngas, that's going to be very helpful from a project finance perspective. And it allows you a little bit more flexibility on the contracting side. If you say, hey, we don't necessarily have the fixed price contract on the carbon or fixed price contract on the biochar, but we're also selling all of these other ancillary products, we can kind of work around some of those things on the lending side a little bit easier.
I might take the question a different. Short answer is we don't really think about carbon. It'll be what it'll be. But I might just provide a different perspective than Tanner, and we are taking a little bit of a different view, maybe it's contrarian, to focus on fewer products. I mean, the pro forma is definitely tougher when you're focused on fewer products, but we're taking a little bit more of an operational focus and have just in the past seen people trying to do too many different things, and it's hard to optimize each thing. And so if you're designing your biochar plant for power and then you're making char out of it, it's just a different type of char. If you're using pie oil as just a byproduct, it's just a different quality of pie oil. And so we're taking the perspective of the pro forma is going to be more challenged in the beginning, just making a fewer amount of products, but we're focused on quality first. It's just a different approach.
I think that's really reasonable too. We don't want anybody getting spread too thin. And so, to the extent that you have optionality there as sort of a backup, I think we view that as a strength, but we don't want you focusing on 15 different things at once. Are you guys seeing in the market a lot of fixed offtake? I think that's probably the biggest thing that we're missing in terms of kind of bulletproofing those projects. Are you seeing some fixed offtake for char or whatever the product is that they're producing?
Very little.
That's what I thought. That's what. I think that may be the biggest challenge for an investor or a lender, or making sure that you can withstand a certain amount of, whether it be like working capital turnover or decrease in the price, or not being able to sell volume, things like that. So important to think about as you structure those.
Awesome. Well, we've heard a bit about your thesis. We've heard a little bit about what the ideal project looks like. We've heard about the risks. We've heard about the teams that you like to invest in. So I think at least I feel like a little bit of an insider as to what you guys are looking for in a project. And for any individuals that are here, if they think they've ticked the boxes and they have a great project that's going to match with their thesis, how can they get their project in front of you? And is there a specific project size that you guys like to see?
I guess I can kick it off. So we have an email address that people could send in their information about their projects. It's opportunities@carbonstreaming.com. And obviously we work with Grain. We use Grain as kind of a pre-screener for the projects that we would like to take a closer look at. So those are probably the two main ways to get in touch with us.
Yeah, we also have an email, I forget what it is, but it's on our website, nexusdevcap.com. Our check size is 5 to 10 million. We can go a little lower, we can go a little higher for the right opportunity.
You can email me directly. My information is in the app, but it's just my name, tanner.martin@amerisbank.com. I always hate to limit people on the project development side, but realistically, the project needs to be a little bit larger to be able to be financed. And that's just to be able to put together a strong project with fixed price contracts and offtakes and EPC. We'll do loans as low as $1 million. And typically we'd like to see something in the $2 to $5 million range, and we'll partner that with some equity to build out the capital side.
Sorry, I forgot to mention size. So typically we're looking at projects at least, like I said, 5,000 tons of biochar per year. Our check size is anywhere from 3 to 5 million. But we do work with other co-investors and could fund much larger projects. On the carbon credit side, bigger is always better. So off-takers are looking for bigger projects. They have limited capacity to do due diligence. They're not interested in looking at 30, 40 different, they don't even have the capacity. So the bigger is better.
And maybe just on top of that, are there investment vehicles or types of capital that you like to invest alongside?
From the debt side, we're pretty agnostic as to the source of capital. So we've looked at projects that have forward carbon contracts. We have traditional equity. We can partner alongside some mezz debt or preferred equity. We're pretty comfortable with structuring around those things. The main thing that our bank or any bank is going to want to see is that you have a first security interest in the project, and we're first to get repaid. So however we structure the additional investment, that's the one thing to think about.
I mean, from our side, like I said, we're providing anywhere from 20 to 40% of the capital stack. The majority of the capital is coming from senior debt. We do take security over the carbon credits. That's the only carve out that we have and the requirement with the senior lenders. But certainly looking for the project developer to secure the remaining pieces of the capital stack.
Yeah, we'd love to partner with both of you too.
Well, great. So I'm fortunate enough that I get to ask you guys questions on a regular basis. So I've asked you quite a few today, and I think it would be a great opportunity maybe to open it up for everybody here to ask you questions. So if you're in the audience and you've heard the conversation so far and you have some specific questions, you can go ahead and raise your hand. I understand there's a mic runner going around. And you feel free to ask your question, and if it's directed at a specific member of the panel, go ahead and let us know.
Coming.
So I hear you guys saying that you're interested in larger transaction sizes. So maybe, actually I have several questions. Do you have a recommendation for smaller projects or potentially even grouping projects together, which would make it more complicated for you, but nonetheless. So now we're looking at a market that's changing pretty fast. So what kind of time frame are you looking at for the out years and the revenue stream? And then interest rates also play a role. And I see that you're interested in helping vet projects. Can you help people, even the smaller projects, just help vet them, even if you don't invest? And is there potential for, just looking at it as an investor, in having like green bonds that individuals would you would assemble individual investors and then sort of be a pass-through and call it a green bond? That might be attractive to people.
All right. There's a lot of questions there. I'm going to try to remember what you asked. I think from the smaller project perspective, I mean, there are a lot of lenders that will do kind of one-off startup projects. If you guys are familiar, anything under a couple $1 million, if you're familiar with the SBA 7A program, it's really designed for small business startups that are less than $5 million, essentially. Our bank will do SBA 7A loans. The startup requirements are, I can talk your ear off on things like that. But, I wouldn't say that it's, I lost my train of thought there. As far as rolling in multiple projects into sort of a single loan structure, I think that creates a little bit more complexity depending on where the projects are in relation to one another. And then you have to, from a project finance perspective, button up all of the contracts at each various sites. And it becomes a little bit onerous on an equity and a debt closing side. And so it's a little bit more challenging to do something like that from the debt side. I don't know about the equity side.
I mean, from my standpoint, I'm not aware of capital providers focused on small projects, but I would suggest that regardless of the size, that you have a similar commercial structure, right? You want visibility into cash flows. So in terms of offtake on biochar, that's very helpful if you have that's key. And on the carbon credit side, again, we don't necessarily get involved with smaller projects, but I think there are other people that would look at basically marketing those credits for you.
Yeah, I think those are all great questions. The issue with most of us for doing small projects is it's the same amount of work and the same amount of cost, and lawyers are expensive and people's time, and so there's just a minimum threshold to get involved. From my standpoint and equity, I think that it's good to aggregate a lot of those small projects, and then you would do a corporate level investment. Some equity investors might like that, so that would be my way around that. Some of your other questions in terms of forecasting, we have to pretend to be able to predict the future, to underwrite it. And so, we are forecasting biochar prices for 15, 20 years, something like that. The way most people, finance people do it is you just forecast it for a couple of years and then you stick a multiple on earnings or a multiple on revenue. There's just like a cheap way to get around it. I'm just trying to touch on as many questions as I can remember because they were good ones. Interest rates, yeah, those probably impact Tanner more than impact me. Green bonds, I haven't looked at that. I think that's all I can remember.
Interest rates are going to be, it's going to vary depending on the nature of the project, size of the project, and all of the commercial terms around it. So I can't really quote you interest rates right off the top of my head. It's really challenging based on whatever the market is, and as the Fed rates adjust, interest rates tend to come down, and vice versa.
Great. Did that answer your questions?
Yeah.
On the debt side, it's a little bit more challenging for us to vet projects. I know that there are some consultants out there that will do some work for you and kind of help you structure things. But from the bank side, it's a little bit challenging just from a bandwidth perspective to spend a lot of time on projects that we're not going to be able to finance.
Yeah, same with us. There are other consultancy firms, including our, Nexus PMG, to do the consulting side.
Yeah, no, and at Grain, that's actually one of the things that we're focused on in building the platform out, is to provide a digital tool that will help you get to the stage where your project is ready for meeting the investment. So ticking some of those risk boxes. And so we're looking to help project developers in that way. So while it's not within these guys' remit, it's something that we're focused on and we're working on at Grain.
Josh, I'm particularly interested in your contrarian point of view. I tend to gravitate towards those, not focusing on carbon credits as much. And you seem to suggest that you'd like a very simplistic pro forma that you would like hands-on in developing out further. I was wondering if you could go into a little bit more in-depth description, because it's just not something I've heard from the folks that we've pitched to in the past.
Yeah, well, being contrarian is not always a good thing, so I don't need to pretend that I have the right answer here. Our operational experience is that operating is always very difficult. We don't want to start with a company that's, in our world, these are relatively small dollars. I mean, the infrastructure funds that we normally dealing with are deploying $50 million to $1 billion at once. And we really just want to make sure everything's buttoned up as much as possible. And so we are just more focused on making sure we really know how to create biochar right first, as opposed to creating biochar and electricity and pie oil simultaneously. We expect it's going to cost a little bit more money, but it's probably specifically to do with our model that we are specifically trying to build portfolios that the infrastructure community is going to be attracted to in a couple years. And we know they just get scared of complexity.
I would imagine if it gets too complex or you have too many revenue streams, it just creates an opportunity for one of those legs to fall off and create some issues there. So, making it simpler makes sense. Kind of along those lines, I'll just ask a question. What's the typical or ideal exit for Nexus or other equity investors? Are you all looking at a 3, 5, 7-year time horizon, or are you going to hold them for 15 to 20 years?
Our model specifically is to target, it should be ready infrastructure capital in 3 years. And if I could get on my soapbox a little bit, do you mind? Okay. So our thesis is that the investment world is not actually one axis that goes, no offense to this table, that goes from like grants to equity to debt to infrastructure. There's actually a bifurcation in the small checks, in that the venture groups and the growth equity want something that's fundamentally different than the large infrastructure capital, and then it sets you off on a different path. Venture typically wants differentiated technologies that can be disruptive and can produce products much better at a much lower cost. That generally comes with IP differentiation. They do TAM analysis. They look at, how market share they can capture. Infrastructure wants something that's been done 1,000 times before. There's zero tech risk. You can have a backstop from a creditworthy equipment provider. And so it's just different. And so when you go out and you try and raise anywhere from $1 to $20 million, you're talking to the venture community that wants you to do something different. And we've seen a lot of people that are kind of forced into doing something different But then when you try and raise $50 to $100 million, all of a sudden you're raising from people who don't want you to do anything different. So you kind of get stuck. So our whole model is to write the small checks that are $5 to $10 million, but we'd like you to not be doing anything different. We want you to be using proven technologies because we think like the infrastructure funds think. So we're trying to keep you on the axis to raise the 5 to 10 from us and set you up well to raise the 50 and 100 from the groups that write those checks.
I think that's really helpful context for folks that I've been talking with. You know, trying to raise from a typical VC platform. VCs have a time horizon and they want to exit, and they want to exit at a really massive multiple. I don't think you're looking at a traditional VC exit in biochar or even most energy projects. So that's really helpful context. When you're going out, you're pitching investors, you're talking to them, looking at it over the time horizon and the life of the project, and viewing it more from an infrastructure asset rather than a disruptive tech asset that's going to command a 20x exit in 2.5 years.
Actually, now I'm going to ask a question. So on top of that, Alec, when you're thinking of your strategy and sort of multiples, do you sort of see yourself more in the far end bucket or more in the infrastructure fund kind of bucket? Is it stable revenues? Is it upside? How do you think through that?
Yeah, I mean, we've had an evolution in kind of our strategy when the whole carbon market kind of went belly up last year. We really looked at, well, where are there bright spots? Where is the demand strong? Where are pricing being maintained? And that's on the removal side. And so to us, what's really exciting is this opportunity to lock in really attractive long-term offtake at prices that give us excellent returns, provide excellent returns to the project developers. So that's why we're all in. We don't know how long this kind of Goldilocks situation is going to be in place, but we're going as fast as we can to basically provide as many carbon credits into the market and lock in these contracts right now. And we don't expect the prices for biochar carbon credits to remain high forever. We do expect them to drop off once more supply comes in, but this is the time to lock in those contracts.
Other questions in the audience?
Hi, my name is Scott Burdett. I'm with the U.S. Forest Service with Region 5 Wood and Biomass Utilization. We run the grant program. And my question is, we've got 7 priority landscapes for wildfire crisis in the state. And what do you guys require in terms of feedstock guarantees in order to get your programs to finance projects?
Nothing. I mean, we'd like visibility, as we kind of discussed before, and like a path towards getting certainty on where it's going to come from, but we don't require any guarantees.
Yeah, we're kind of in the same boat on the debt side. I think feedstock is fungible to a certain extent, but also it's a little bit easier to gain visibility to, depending on where you put it. There's a bunch of resources and consultants that can say, hey, you have X amount of woody biomass or ag waste in this area, and you can reasonably get it for this price or less. So we don't require that either.
We're looking for offtake agreements, long-term offtake agreements with preferably fixed pricing, so we kind of understand what the cost structure of the project is. That's kind of the goal.
Thank you.
Gentlemen, thank you for the information. This is all very enlightening. When you think about scale, do you think about pushing more fuel through a centralized plant, or do you think about remote plants and spreading the team across different locations?
Sure. I mean, we're looking for projects that have expansion opportunities there right on site, preferably, because that's the easiest and the fastest ways to get that volume up. But obviously, if they have identified opportunity in other locations with attractive feedstock, that's good as well. But for us, we try to look we prioritize projects that have that additional scale up right there on the site.
If I understand the question correctly, you're asking whether you should expand to a separate site or just push more through a single site. So from our perspective on the debt side, we'd probably want you maximizing output at your single facility to make sure that, make sure everything's operating according to the way that it's built. You don't want to shove something through that you can't do it before you start to expand. So maximize output at the single site, and then you can either bolt on something additional at that same site or expand it to a different location if you're able to do it. But as you expand, especially from the debt side, the credit department at most banks is going to see that you have proven track record at the first site before you move on to the next one.
Yeah, from our perspective, there's definitely a sweet spot, which we don't know yet. I mean, if you're too subscale, your cost structure is out of whack and you can't make money. If you're too big, you're at risk of messing up your operations. And we've seen some people try and plan some sites that were just way too big. So in line with our earlier strategy of just trying to crawl, then walk, then run, we personally prefer starting subscale and growing into something that's in that sweet spot as opposed to going the other way.
Yes, this is Henrik Nordstrom, co-founder of the Oak Tree. I got a little bit surprised over the comments on the feedstock agreements from Tanner and Josh, that you don't require the feedstock agreements, or that's what the understanding was. Whereas, Alec, you mentioned you do long-term offtake agreements, but with an offtake agreement, you also need the matching feedstock agreement, right? Or is that a question for Tanner and Josh, that you are in that early stage that you don't need them at that point? Because if you want to reach financial closing on a deal, you definitely need the feedstock agreement matching the offtake agreements.
Yeah, I think was answering the question more around the feedstock guarantee. We'll want to see a feedstock agreement. I haven't personally seen a feedstock agreement that will match the tenor of the loan, 10 to 15 years. It's not as beneficial for the feedstock provider, especially if you're purchasing. But ideally, we would see 3, 5, 7-year feedstock agreement, and also have some backing data that will show there is enough feedstock available in the area, whether it's wood waste or otherwise, to put through the plant.
Yeah, well, and I appreciate the question, because that's kind of the thesis of our model is, and you say to reach financial close, you need a feedstock agreement and you need an offtake agreement. And that is exactly why we exist as Nexus Development Capital, is because the typical financial close from the typical investors, you would need exactly that. And what we've seen is a lot of projects get stuck because there's a gap, and creditworthy counterparties. A feedstock agreement is only as good as the counterparty, and it's hard to get a creditworthy counterparty to give a long tenor feedstock agreement to a group that hasn't done anything yet. And so a lot of people get stuck. So that's really the purpose of our capital, is to be able to take on that risk, where you're right, a lot of people wouldn't. Prove it out a little bit. Hopefully you get a creditworthy feedstock in the next phase, and that's where the bigger money comes in.
Alec, you have something?
Again, that's the goal, to get, it's not necessarily where we start off from. Like I said, in some projects, you're only maybe able to get a shorter term supply agreement. If we, through our due diligence, see that there's abundant feedstock available in that area. So we have flexibility, but in terms of preference, we would like to see long-term feedstock agreements with creditworthy counterparties at some kind of fixed price.
Thank you.
Hello, I'm Paul Anderson. I deal with very small production units like cooking stoves and a 55-gallon drum. You would like to purchase have purchase agreements for the carbon credits and things like that, buy low, and then I'm assuming that you wish to then sell high. I mean, you are in the middle trading it upward. To what extent is that part of your business plan as opposed to you're not buying credits to satisfy the emission issues, the carbon issues of your particular banks. And I point that out with regard to the case of those very small entities in third world countries where they are not in the same bracket. I mean, they cannot get to these higher numbers, and yet they need a price which would be adequate to be able to do it. They're very high labor costs and things like that. So if you could address that, I'd appreciate it.
Sure. The way the streaming model works is we make an upfront investment that's used by the project developer to implement the project. We typically receive 100% of the carbon credits generated by the project, and our sales team goes out and tries to sell those credits at the highest possible price, whether it's spot or forward sales, and then we share back the bulk of the revenues with the project developer. So our incentives are always aligned. We're trying to sell for the highest possible price, and the project developer participates in that hopefully higher price. So that's why the streaming model has been very attractive for project developers. They are participating when most people expect there to be higher prices. We typically don't get involved in terms of brokering credit sales. They're usually part of a stream that we've made the investment in. Although we are kind of seeing in the market those types of opportunities, and you know, given kind of the infrastructure that we've put in place with credit buyers, we may be exploring some opportunities that come our way. But typically, we're only selling credits that are part of our stream.
Yeah, on the debt side, we don't do a whole lot with the credits. We don't we use them and validate them as a revenue source, but we're not using them to offset any sort of carbon on our bank's level.
Same as Tanner. The credits are a revenue stream, but yet to your point, really what we are doing is, I guess, buying low and selling high in terms of company value in the sense of the discount rate. Other groups will put on the future cash flows, and so when we invest, there theoretically is a higher discount rate on those cash flows because there's a lot higher risk, and hopefully we put in money and prove out the business plan, and then there should be a lower discount rate on those cash flows.
I think there was one other question around maybe like international or smaller markets. Unfortunately, we are limited to United States loans, so everything that we do falls within the 50 states.
So although there's a lot of similarities between the three of you, I think that we've heard that there are a lot of priorities that you have that are very different from one another, and it's very nuanced in terms of the types of projects you're interested in or what you're willing to take risk on or not willing to take risk on. But I don't think a project would know that unless they were here today or if they came and spoke to you each individually. So how do you share that information, and how would projects actually know like who to approach, or like where is that information and how do you get it?
That's a great question. Yeah, we spent a good chunk of money on a marketing firm last year to try and spread the word. But you're right. I mean, I think all three of us are approaching the same problem from a different angle. There's a lot of different groups trying to spread this word of figuring out how to unlock this. See Jason nodding. I feel like grain has its own angle. Maybe this is a grain plug. It's perfect. I don't have a good answer. But yeah.
I would argue that I think we're probably all coming at it from a very similar place. We maybe just prioritize things a little bit differently. But anything that Josh is investing in on the Nexus side, we're going to look at the same things on the debt side in terms of making sure your project is fully buttoned up. We may be able to grant a little bit of flexibility in terms of offtake or feedstock or pricing considerations when we're underwriting it. But at the end of the day, if you have a bankable product, you generally have an investable project too. We look at it slightly differently. We want to make sure we hit a debt service coverage. You guys are looking for a targeted yield or an exit multiple. But I think we're probably viewing it from a very similar way. And likewise, I think grain does a good job kind of aggregating those resources. And we're fairly new to the market, and we're always willing to talk to people.
So we're a public company listed on the New York Exchange. We have a very good website you can go to. There's a full disclosure in terms of the investments that we're making. You can take a look at the 2 biochar investments we've made, kind of, work out the investment structure from there, and also our filings present detailed information on each investment. So that's one way to do it. Obviously, we work with companies like Grain who know kind of exactly what we're looking for. That is a good way to get in front of us. But again, having those elements buttoned up in terms of the commercial structure is key. Having a pre-LCA put together, having the feedstock identified, having the biochar offtake, having those kind of contracts developed, and knowing where the biochar is going, and having it in a way that could be very quickly identified. You know, we don't want a project developer to come with their box with like, oh, punch pit here. Like, get it organized. put a feasibility study together. Get a document together that presents this in a clear way, so it could be, you know, the less work we have to do, the better it's presented, the better it is for the project developer.
Yeah, I think I'll pop onto that too. You know, a lot of times people come to us with an idea, and we like ideas because that's how projects get born. But it's very difficult to put debt and equity on an idea. So the more that you have the project sort of started with the various contracts and site control and technology selected, that's going to go a long way to getting things financed.
Ryan, what do you want to say?
I think you guys said it all, but that's why we're here, to aggregate sort of the projects that will match with your investment thesis and take them from idea to ideal so that you guys are ready to write a check and partner.
Hi, nice to meet you. I'm Jose Alejandro Martinez from Colombia. I work with a company called Biochar. We are into the pilot project with the forestry industry. And I have a question because I don't know if you have some restriction, geographical restriction or limits to supply, to support, to help projects outside USA.
So we have 23 projects in our portfolio. Most of those are located outside of the US, but for biochar, we see the most attractive opportunity in the US because of the government programs in terms of supporting biochar purchases. Credit buyers are interested in buying credits that are kind of in location where they have operations. So most of the credit buyers that we're dealing with are coming from the US or Europe. So that helps as well. So for ourselves, I think the low-hanging fruit right now is the US, given the NRCS programs in place for biochar.
Yeah, we are just US and Canada to start.
Unfortunately, we're US only. We're a Southeast regional bank, so we stay inside the 50 states, unfortunately.
And maybe just to add on, there are some other investors that are looking at international projects and participating both in biochar as well as carbon markets internationally. Some of those are philanthropic capital, but also large lenders, large banks that are looking to get into the space. Again, you get into size and fit and a lot of the things we've talked about today. But while they're not up here, they're out there, and they're getting more and more into the space.
One last question.
Thanks a lot. What would you guys say to project developers that are worried about the long-term demand for carbon offset credits and the long-term price of those credits, even beyond like initial financing? What would you say to them to, I guess, allay those fears, or what are your thoughts on that?
Look, we see the demand for removals growing. In terms of pricing, again, for biochar specifically, right now there's a shortage. As more projects are developed, you're going to have more supply coming into the market. You know, we have a conservative view, I think, over long-term prices as coming off where they are now, but still remaining healthy enough to support projects. But for the next 5 years, we see basically more demand than supply in the market, and that's key, and it's one of the bright spots in the carbon market.
I think on the debt side, we don't take a huge view on the kind of long-term carbon removal credit market. What I will say, and kind of go back to what we talked about earlier, is making sure you have revenue streams that are not just carbon. I know that Nexus was talking about not really taking an outlook on that. It's more important for us to make sure that you find a valuable place to put your biochar and to sell your biochar, and then use the carbon credits as sort of a bonus on top of that.
Yeah, I would think that I'm not that concerned about it. The perspective that we have is coming from the infrastructure world and the massive amounts of money they want to deploy in environmentally friendly technologies. I think Brookfield announced the other week that they have the world's largest climate fund. It's like $20 billion or something in one fund. I mean, the numbers are staggering. And they've been struggling in figuring out ways to deploy it other than wind and solar. And those have their own challenges in terms of the grid. And a lot of the stuff that we look at is very niche-y. I'd say the two biggest things that those funds are interested in and the things that we look at are hydrogen and carbon removals. Yeah, and you can even debate, the validity of hydrogen and the use cases and whatnot. But there's a ton of interest from the funds of how to get carbon out of the air. And I think a lot of people who look at different ways we can get carbon out, but DAC is really the only other example. I think a lot of people in this room would say biochar is a more effective carbon removal tool than DAC. So I just think in the broader, at least in our world and where the infra funds are interested in, I don't think that's the biggest risk. I agree it's a little bit more on the operational side where you're going to put the biochar.
John, was there a question?
No, sorry. I believe we're at time.
Oh, we are?
Yeah.
Wow, that flew by. Guess time flies when you're having fun. Well, thank you guys for joining us today and joining the panel. Thank you everyone for the questions. And we can continue the conversation at the Grain booth or at 2:30 when we dive into the details of financing in practice and a few other great finance sessions. Thanks so much for having us.
Biochar.org appreciates the support of our sponsors, exhibitors, presenters, and attendees. We look forward to seeing you at our next conference in September 2025.